Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at UnitedHealth Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's get right into it.
Yeah, let's.
We are opening the file on a company that, effectively acts as the backbone of the American healthcare system.
It really does.
But lately, holding this stock has felt less like owning a steady utility and more like riding a mechanical bull.
It really has. We're talking about UnitedHealth Group, and if you think insurance is boring, you simply haven't looked at this chart lately. It has been, well, absolute chaos. It is one of the most interesting situations in the market because you have this undeniable juggernaut, the biggest player in the managed care space, dealing with some very real, very public volatility.
Exactly. And I think for a lot of people, UnitedHealth is just the big insurance company, right?
Mm-hmm.
But when you peel back the layers, especially looking at the numbers they just put out for full year 2025, it's a much more complex beast.
Oh, absolutely.
We are talking about a company that brings in nearly $500 billion a year. Let's just pause on that scale for a second.
It is staggering. The headline numbers for 2025 are just massive. They reported consolidated revenues of $447.6 billion.
$447 billion. That is just a lot of money moving through one system.
It is. And to put that in perspective, that's larger than the GDP of most countries.
Really?
And, despite all the headlines about trouble in the sector, that top-line number actually represents a 12% increase year over year from 2024.
A 12% increase.
So on the top line, the growth engine was definitely running.
And that's the first disconnect I want to highlight. You see all these headlines about crisis and volatility, yet the revenue is growing at double digits.
Right.
12% growth for a company this massive is usually cause for celebration.
Yeah.
So where is that growth coming from? Is it just people paying higher premiums?
It's actually firing on both cylinders, which is key to understanding this whole business. You have the insurance arm, UnitedHealthcare, which grew 16%.
16. Okay.
To nearly $345 billion. But then you have the services arm, Optum, specifically Optum Rx, their pharmacy care services.
That's right, Optum.
That also surged 16% to over $154 billion.
Okay, so wait a minute. You've got double-digit growth on both sides of the house.
Yeah.
People are buying the insurance and they're using the pharmacy services. The demand is clearly there.
Clear.
But, and here's the big but, if revenue is up 12%, why did the mood on Wall Street turn so sour? Why has the stock been under so much pressure? Because usually numbers like that are a slam dunk.
This is the crux of the issue, and it's where you have to look past that revenue line. Revenue creates vanity, but profit creates sanity.
Mm-hmm.
And while the money coming in went up, the money they actually kept, the earnings, took a significant hit. Adjusted earnings from operations actually dropped to $21.7 billion. Yeah, that's down from $34.4 billion the year before. And their adjusted EPS, their earnings per share, it fell to $16.35.
Okay, so revenue up double digits, but operating earnings dropped significantly.
Yeah.
That's a divergence that usually makes investors pretty nervous.
Very nervous.
It tells me their costs just exploded. What happened? Did they just spend too much on office parties?
I wish it were that simple. It really comes down to one critical metric in this industry, the medical care ratio, or MCR.
Right, the MCR. Let's break that down.
Okay.
For everyone listening who doesn't spend their day reading insurance filings, that's basically the cost of goods sold for a health insurer, isn't it?
Precisely. It represents the percentage of every premium dollar that goes out the door to pay for actual medical care doctors, hospitals, surgeries, drugs.
Got it.
So if you collect $1 in premium and your MCR is 85%, you keep 15 cents to cover overhead, tech, and your profit. If that number goes up, your profit margins just evaporate.
And in 2025, that number went the wrong way.
It jumped significantly. In 2025, the MCR rose to 88.9%.
Wow.
For context, it was 85.5% in 2024. So in the razor-thin margin world of insurance, a 3.5% swing is a control. It's catastrophic. It's the difference between a banner year and a crisis.
That is a huge swing. So almost 89 cents of every dollar is immediately going out the door to pay for care.
Right out the door.
What drove that up? Was everybody just going to the doctor more? Or was there something structural happening?
It's a mix of things, but the structural issues are the ones that really matter for the long term. First, you had the utilization factor. People simply went to the doctor more.
Okay.
But the bigger hammer was the government. You had a funding reductions from CMS, that's the Centers for Medicare and Medicaid Services, specifically pressuring Medicare Advantage rates.
So this is the government basically telling UnitedHealth, we're going to pay you less to manage these seniors.
Exactly. Or, maybe more accurately, we aren't going to increase our payments enough to keep up with inflation.
Right.
Plus, you had impacts from the Inflation Reduction Act kicking in, which changed pricing dynamics for drugs. It was essentially a perfect storm.
A perfect storm where costs went up due to inflation and utilization, while the revenue per patient from the government just stagnated.
You got it. The government tightened the purse strings, and UnitedHealth had to eat the cost. It's a classic margin squeeze.
Okay, that explains the earnings drop. But obviously the market is forward-looking. We don't buy stocks for what happened last year.
Never.
They've given guidance for 2026, and this is where I think the story gets really interesting and maybe a little controversial.
It is a fascinating pivot. Usually, companies this size preach growth, growth, growth. But for 2026, UnitedHealth is projecting revenues to exceed $439 billion.
Hang on, did I hear that right? They did $447 billion in 2025,
Yeah.
and they're guiding for $439 billion in 2026.
That's right.
So they are explicitly telling us revenue is going down.
Flat to slightly down, yes. And for a company that has been a growth compounder for decades, that is, well, it's almost heresy.
It really is.
But, and here's the twist, while revenue shrinks, they are forecasting operating earnings to rebound to over $24 billion. And they expect adjusted EPS to jump back up to greater than $17.75.
So shrink the top line to grow the bottom line. That sounds like a massive cleanup operation.
That is exactly what it is. They are focusing heavily on pricing discipline. In plain English, they're dumping bad customers.
Right.
They are looking at their book of business and saying, if this plan or this region isn't profitable at these new government rates, we just aren't going to sell it. They don't want unprofitable revenue.
They're cutting the fat off the steak.
Aggressively. They are also talking about rebaselining Optum to recover those margins. They're targeting an MCR of 88.8%, give or take 50 basis points. So the strategy shifts from land grab to fortress building.
Which brings me to the next big question. If I'm looking at UnitedHealth versus the competition, the Elevances, the Humanas, the CVSs of the world, what protects them?
Yeah.
Why should I believe UnitedHealth can pull off this margin recovery better than the others?
Yeah.
Because dumping revenue is risky. If you stop growing, you lose that compounding magic.
It comes down to what we call the integrated ecosystem. And frankly, nobody does this quite like UnitedHealth. If they were just an insurer, they'd be in trouble. But they own Optum.
The ecosystem. I like to think of this as the Apple strategy of healthcare.
That's a great analogy.
You get the user in, and you monetize every single part of their journey.
That's a perfect way to put it. Think of it as a two-engine jet. You have UnitedHealthcare, the massive insurance engine that brings people in. Then you have Optum, which is technology, data, pharmacy benefits, and direct healthcare delivery. These two feed each other.
Okay.
When a UnitedHealthcare member goes to the doctor, ideally they go to an Optum doctor. When they get a prescription, it's processed by Optum Rx.
So the insurance side pays the medical bill, but they're paying it to themselves.
Exactly. They capture the margin at multiple points in the value chain. It creates incredibly high switching costs and network effects.
Right.
And the data proves it's working. Even with all the financial headwinds in 2025, Optum Health added 650,000 new patients.
Wow, that's a lot of people. That is significant stickiness. And I assume having that integrated model helps them control costs better than a standalone insurer.
Absolutely.
If you own the doctor's office and the data feed, surely you can spot inefficiencies better than a competitor who just writes checks.
You absolutely can. They have a target of $1 billion in tech-driven savings by 2026.
$1 billion.
Because they own the data pipe and the care delivery, they can use AI and analytics to route care more efficiently. A fragmented competitor just sees a claim form. UnitedHealth sees the whole patient journey.
Right. If you're just writing checks for claims, you don't see the whole picture. If you own the clinic and the data, you can see where the waste is.
Exactly. And that efficiency translates to cash flow, which is another area where UnitedHealth is essentially in a league of its own.
Let's talk about the checkbook. Because at the end of the day, cash is king. Even if margins are squeezed, this company is a cash-generating monster.
It's fortress-like. In 2025, they generated $19.7 billion in operating cash flow.
Wow.
That is 1.5 times their net income.
Nearly $20 billion in cash flow. That gives you a lot of options.
It certainly does. And for 2026, even with that flat revenue guidance, they expect to generate over $18 billion in cash flow.
Mhm.
And they aren't just sitting on it. They plan to return roughly $8 billion to shareholders in dividends and another $2.5 billion in share repurchases.
That's what I like to hear. And this is key for the listener wondering, why hold this stock if growth is stalling? They're effectively paying you to wait. It's becoming a capital return play.
Precisely. And that capital allocation strategy is a huge part of the investment thesis. They have the liquidity to weather storms that might sink a smaller player. They can buy back their own stock when it's cheap, and they can keep hiking that dividend.
Okay, so we have a company with a massive moat, huge cash flow, but some temporary earnings pressure and a flat revenue outlook. Let's look at how the market is actually treating the stock, because you mentioned earlier there was a plunge in the sector.
Yes, let's talk price action. It has been a bit of a roller coaster. Recently, there was a sector-wide panic. Some reports cited peers dropping as much as 19%, triggered largely by fears over Medicare rates.
Right.
The whole sector just gapped down. It was ugly.
I remember seeing red across the board for anything related to managed care. But UnitedHealth didn't stay down.
No, and that's the signal. After UnitedHealth released those Q4 2025 earnings, the ones with the lower EPS we just discussed, the stock actually raised 4%.
Wait, so earnings down, stock up. That sounds completely backwards. That's the classic sell the rumor, buy the news dynamic.
It does, until you realize the market is a forward-looking mechanism. That bounce suggests resilience. It suggests that the bad news was already priced in, and investors looked at the 2026 guidance, that promise of $17.75 EPS, and said, okay, the worst is over, I'm buying the dip.
It implies capitulation.
Yeah.
It tells us that the market had already priced in a disaster. When the reality was just bad but not fatal, investors stepped in.
Exactly.
So is the stock technically oversold then?
It certainly looks like it could be in a psychological oversold state. When you see a stock hold firm and bounce while the rest of the sector's panicking, that's usually a sign of strength.
But surely not everyone is bullish. I mean,
Huh.
usually when a stock drops, the sentiment indicators go through the floor. If we do a vibe check on Wall Street right now, what are we seeing?
Oh, absolutely. The quantitative sentiment is definitely bearish to neutral. Looking at sentiment scores from Alpha Vantage, they are largely negative. The weighted relevance score is averaging around negative 0.48.
That is firmly in bearish territory. Pretty gloomy.
It is.
So the algorithms hate it, but the humans are buying the dip. What is the main driver of that negativity? Is it just the earnings miss?
No, it's actually more about the future policy risk. The big anchor dragging down sentiment is fear of the government. Specifically, the CMS Medicare Advantage rate proposal for 2027. The proposal was a 0.09% hike.
0.09%. That is basically flat. And considering medical inflation is running at, what, 4 or 5%, that is effectively a massive pay cut.
Exactly. The industry was hoping for 4 to 6% to cover rising medical costs. So when that 0.09 number came out, it spooked everyone. That is why the sentiment scores are so low.
I see. So the market is terrified that the government is going to squeeze them even harder in 2027. But you mentioned a contrarian angle earlier.
Right. While the headline sentiment is bearish, if you look at flow data from places like MarketBeat or NASDAQ, there's a neutral to positive undercurrent. It suggests that the smart money thinks this fear is overblown, or at least fully priced in at these levels. It implies that investors believe the final rate might be negotiated higher, or that UnitedHealth can adapt.
So the bad news is out, everyone knows it, and the stock is still standing. That's usually an interesting setup. So, looking ahead, if you're a listener holding this stock or thinking about buying, what are the mile markers? What's on the catalyst calendar for the next 3 months?
The big one is obviously Q1 2026 earnings, which will likely report in late April.
And what's the key metric there?
It's all about the MCR, that medical care ratio. They guided for 88.8% for the year. We need to see if Q1 tracks towards that.
Yep.
If MCR comes in hot again, say over 90%, that 2026 recovery story falls apart and the stock will get punished.
Got it. So watch the MCR like a hawk. What else?
We're also looking for any investor updates regarding this rebaselining of Optum. We need to see concrete evidence that the restructuring is working.
Yeah.
And from a macro perspective, interest rate cuts. If the Fed cuts rates, it helps their valuation and makes it cheaper for them to reinvest that massive free cash flow.
Okay. Now, I want to play devil's advocate for a minute. We've painted a picture of a resilient giant. But what is the nightmare scenario? What is the bear case here that keeps you up at night?
It's a fair question. The biggest risk is that prolonged Medicare Advantage pressure. If that 0.09% rate hike sticks for 2027 and maybe happens again in 2028, margins are going to get squeezed further.
Mm-hmm.
There is only so much efficiency you can squeeze out before you just start losing money on every patient. You can't synergy your way out of a structural deficit.
Right. That's the existential threat of being in a regulated industry.
Right.
What about the growth angle?
That's risk number 2, revenue stagnation. We talked about the flat revenue guidance for 2026. If they can't restart the growth engine by 2027, the market might re-rate them. UnitedHealth has always been traded as a growth compounder. If Wall Street decides you're no longer a growth stock but a no-growth utility, your PE multiple could contract significantly. You could lose 20% of the stock value just on multiple progression, even if earnings stay flat.
That is a really dangerous trap. A stock looking cheap based on past growth, but actually being expensive because it's done growing.
Exactly. And finally, there's always the cyber risk. We saw the sector-wide breaches recently, like with HTI Active.
Yeah.
UnitedHealth has largely absorbed its restructuring hits. They took a $1.6 billion charge in 2025 for restructuring and cyber response.
Yeah.
But another massive breach could be a major setback, both financially and reputationally.
Yeah, that $1.6 billion charge is a painful reminder that these systems are vulnerable. Okay, we've weighed the fortress balance sheet against the government headwinds. It's time for the verdict. How are you scoring UnitedHealth Group right now?
Taking everything into account, the massive cash flow, the integrated moat, the over-pessimistic sentiment, I'm giving this a bullish score of 7 to 8 out of 10.
7 to 8. That's pretty confident given the messiness. Walk me through the final thesis.
It really comes down to fundamentals versus sentiment. Yes, the sentiment is terrible right now because of the Medicare headlines, but fundamentally this company is generating massive cash flow. The 12% revenue growth in 2025 shows the demand is there.
Right.
And that integrated model insurance plus Optum allows them to navigate these pressures better than any fragmented peer.
So you're saying the market is overreacting to the policy noise?
I think so. The elevator pitch is this. Despite the noise, they have a clear path to over $17.75 in EPS and 3.6% net margins in 2026. At these price levels, this looks like a multi-year hold or a classic buy-the-dip opportunity. The market is pricing in a disaster scenario that the company's guidance simply doesn't support.
It's the classic battle between scary headlines and solid corporate execution. You're buying the turnaround of the battleship.
Right. This isn't a get-rich-quick trade for next week. It's an investment in the dominant player regaining its footing. And you're getting a nice dividend while you wait.
So to summarize for our listeners, UnitedHealth had a tough earnings year in 2025 due to government cuts and rising costs. But they are guiding for a strong profit rebound in 2026 by cutting low-margin business, trimming the fat, and tightening their belts. They have a massive moat with Optum, huge cash flow, and the stock seems to be holding up despite the bad news.
That is the nutshell version, yes.
Here's a provocative thought to leave you with, though. We talked about that flat revenue guidance. Is it possible that we are witnessing the official end of an era? Are we seeing UnitedHealth transition from a high-flying growth giant into a pure value and dividend play, like a utility company or a tobacco stock? Massive cash flows, high dividends, but zero real growth.
That is the big question for the next decade.
Because if they're becoming a utility, the stock might actually be expensive right now. But if they can turn the growth engine back on in 2027 using this new efficient base, it's a steal. And that implies the market hasn't fully realized the potential yet. Something to chew on.
Indeed it is.
Thanks for joining us on Smart Wealth with Joshua. We hope this helped clear up the noise around UnitedHealth.
Thanks for listening.
Don't forget to like and subscribe. We'll see you next time.